Well, hello and welcome to Principles of Accounting 1. I am your host, Dr. B, and we are in the spring 2023 semester. This is our first session together. We're going to talk about Chapter 1, Accounting and Business, here in a second. Before we jump into the chapter, I just want to quickly talk about the classroom and how it's designed. This is your home page. Hopefully you've all gotten access to the classroom and been exploring already. The first thing you need to do is make sure you have access to the textbook. The textbooks are provided by the bookstore through the software called Brightwave course materials. Easiest way to access the textbook is simply click on the textbook button, click on the Brightwave, and access your material that way. And then you should have access to the book. If for whatever reason you don't have access to the book, or it's throwing you an error message or whatever, please send me an email right away, like today. Okay?
Excuse me,
Yes, Tamara.
Sunea.
Sonia, I'm sorry.
It's okay. It's only one textbook.
It's only one textbook. Yeah, you got it.
Right.
You might see other textbooks from your other courses on there as well. I don't know. But it's only the one textbook, and it's called Fundamental Accounting Principles. Okay? You're very welcome. And thank you for asking that question, Sonia, because the other reason why I like to ask that question is we don't use Connect. Okay, there's no Connect, there's no outside stuff. All right? What I mean by that is you don't have to leave the classroom to access your homework. Everything's right here in Blackboard. Okay? I try to make things as easy as possible for you by having things accessible in Blackboard. So to access your first homework assignment, all you need to do is come down here to Module 1. Open up Module 1. You'll see it's organized by week. We're in week 1. Today's the first day, yeah? So open up week 1. And when you open up week 1, you'll see in very easy order, Introductions, Chapter 1, which talks about the chapter, PowerPoint presentation that we're about to talk about, and then this Chapter 1 quiz. Now, don't freak out. The word quiz, it's okay. All right? I know the word quiz gives you anxiety. It gives me anxiety sometimes, right? Oh, quiz, oh, what's this guy doing the first week quiz? It's okay. I promise I'll make your life easy. For every homework assignment and every quiz, you have 2 attempts to earn the highest grade possible. 2 attempts to earn the highest grade possible. Right, that's a good thing, right? So, as you're working through this first quiz, you have your textbook open, you have your PowerPoints open, maybe you watch the video, you can save it and close it, come back to it. It's not timed. I don't do timers. Okay? You have 2 attempts, highest grade possible. That's a good thing. The reason why I design quizzes and homeworks that way is to help you to learn. Okay? We learn in accounting by practicing. Practicing is very important. So, every quiz, every homework assignment, 2 attempts. Okay? So, please. Yes, Sonia.
Sorry to interrupt you.
That's right.
Is it multiple choice?
Multiple choice, true, false. That's right. Yep.
Okay.
Yep. Just.
How many questions do it range from?
I'm sorry?
And how many questions do it range
5.
from? Do we get high?
Yeah, 5 questions, true, false, multiple choice.
Okay, and that's on every quiz?
I'm sorry?
Is that on every quiz?
Every quiz and every homework assignment, yes.
Okay.
Yep, so you're very welcome. Yeah. Yeah, you got 2 attempts, so I try to make life easy for you. Okay. So for those of you who are following along, please feel free to open up the week 1, module 1, and go ahead and take a look at that PowerPoint presentation, and you can make notes on it if you want, or however you like to take notes. But that's usually a pretty good way to do it. And let's quickly talk about the chapter. And then after we're done with the chapter, we'll talk a little bit more about the syllabus. So, accounting and business. Accounting and business is the foundation of business, right? Earlier, I had mentioned, when we were talking to each other, introducing each other, as I mentioned that accounting is the language of business. We use accounting to describe the financial health of an organization. It helps us to talk to our stakeholders, both internal and external stakeholders. For those of you who have taken a business course before, you would know that our stakeholders are individuals or groups that are interested in information within the business. So we use accounting to communicate the financial health of the business to internal and external stakeholders. That is the purpose of accounting. Okay? We also use accounting to record transactions. A transaction is, as you know, is an exchange of goods and services for monetary gain. Okay? If I sell you a product, you receive the product and I receive the money, right? That's a transaction. If I provide you with a service, I mow your lawn. You provide me with money to pay me for the lawn. Right? That's a transaction. I could go on and on. There's a lot of examples of transactions. You may have had a transaction when you went to the grocery store the other day. You paid for your groceries. It's a transaction. Yeah. So accounting is used to record those transactions. And I'm going to walk through a lot of examples of those kinds of transactions. And so these are the general concepts of why we study accounting. We study it to understand the financial well-being of the company, to understand recording of transactions, to understand the economics of the company. So why is accounting important? We need to understand the financial gains of the company by understanding the transactions. First thing we do is we identify an instance of the transaction. What I mean by that is we identify what a transaction is. An exchange of goods and services for money. That's a transaction. So we identify it first. The second thing we do is we need to record the transaction. I reduce my inventory because I sold a pair of shoes, and I increase my cash balance because I received cash for the shoes. That's a transaction. I record that transaction. And then at the end of the accounting cycle, which we'll talk about, we prepare the financial statements. Financial statements are the records. They represent all of the transactions together. The first financial statement we have is called the income statement. The income statement shows all of the revenue, which is the cash coming into the business. This is from sales. Yeah? Revenue is the sales. Revenue is sales. And the income statement also shows expenses. That's why we call it an income statement. It's also been called a profit and loss statement. It shows revenue and expenses. The second financial statement we prepare is called balance sheet. The balance sheet. The balance sheet shows assets, which are what the company owns, liabilities, which is what the company owes, and equity, what the owners own. So assets, liabilities, and equity are on the balance sheet. And the third financial statement we'll talk about in this course is called the Statement of Cash Flows. This represents cash coming into and out of the business for operating, investing, and financing activities. All of these financial reports are generated based on the transactions that have taken place in the business. That's what this slide shows us. And that's why accounting is so important, because those financial statements ultimately show us the financial health and the well-being of the business. Earlier I had mentioned there are two types of stakeholders involved, internal and external. We need to communicate the financial health of the business to our stakeholders, external and internal stakeholders. External stakeholders, this is anyone outside of the business. The word external means outside. External, outside. External stakeholders would include lenders, which are banks, external auditors, shareholders, those are people that own shares of the business, the board of directors, they oversee the operations of the business, but they're not directly involved in the operations. It's called board of directors. We'll talk more about them later. Regulators, Securities Exchange Commission, the government, those are regulators, yeah? And of course, customers. Customers are external because they don't work for the company. They just shop there. Those are external users. Then we have internal stakeholders. These are people inside the business. These are the employees, research and development managers, purchasing, human resources, marketing, production, distribution, the list goes on and on and on. Anyone working inside the business is called an internal user, internal stakeholder. So both of these groups, these individuals, need to understand the financial information from accounting to help them make decisions. The lender needs to understand the financial health of the company to decide whether to make a loan or not. The shareholders need the information in order to decide whether to buy more shares or sell some shares. For the internal people, the managers need to understand the financial information to make better decisions for the company, put the company in a better direction. Yep. So these are the two types of users. There are a lot of positions accounting, a lot of different jobs. There's financial accounting, managerial accounting, taxation, and accounting-related positions. It's a lot of different people. And all these people work in accounting, and they do a lot of different things within accounting. So accounting is not just one person sitting in an office somewhere typing away. That's not how it works. There's usually a lot of people involved. And that's why you see on this slide, there's a lot of different individual people involved in accounting. In accounting, just like any other position that has to do with money, people need to be ethical. Ethics is at the top and forefront of everything we do when it comes to money. It is very, very important that the people working with money, especially accountants, are ethical. They make decisions based on doing the right thing. Okay? They can identify the difference between right and wrong. Ethical means to make the right decisions by doing the right thing, by abiding by the laws, by abiding by the social norms, by abiding by, etc. Right? Doing the right thing. That's what it means to be ethical. As accounting managers, we identify ethical concerns, analyze our options, and make ethical decisions. That's how ethics are involved in accounting. We as accountants need to prevent fraud. Fraud, unfortunately, affects business. People sometimes act based on pressure or opportunity or rationalization to commit fraud. Fraud is bad. Fraud simply is a way where people steal from the company. Okay, to commit fraud. There is more than one way to steal from a company. It's not just cash, okay? You can steal time. You can steal cash. You can not pay bills. You can write a check that you know won't clear. That's fraud, okay? There's a lot of different ways to commit fraud. We in accounting need to prevent fraud from happening. Congress helps businesses prevent fraud from happening. They passed the Sarbanes-Oxley Act in 2002. What this did is provided individuals, like you and me, who hold stocks in companies through our 401ks, through our other retirement vehicles, maybe you own individual shares, whatever. Congress helped to protect us like companies that committed fraud in the past. This law was passed based off of the Enron scandal. Many of you are probably too young to remember the Enron scandal. Some of you probably remember it. What happened was an organization committed fraud by overstating their sales, made themselves look really, really good. And what happened is investors saw that they're doing really good on paper, invested more money, when in fact the company was not doing well. Okay, that's fraud. Deception is a part of fraud. And so that's why the Sarbanes-Oxley Act was passed. It helped to create a system of internal controls to create for transparency in order to prevent fraud from happening again in the future. The Dodd-Frank Act, another act by Congress that helped to protect individuals in the instance of fraud. Whistleblowers are protected, and there's a clawback provision where if there's excessive pay or something happens, the government can reach back and claw back that money and give that back to the people that were defrauded. Just a few of many acts that were passed in the early 2000s to combat fraud. Why are those important? Because we as individuals need to understand to prevent fraud from happening within our businesses. Now, I want to talk about the foundation of this course, accounting principles. Accounting principles is what this class is all about. And it's really important to understand the four basic principles that we're going to talk about here shortly. These financial concepts are governed by what we call the generally accepted accounting principles. The generally accepted accounting principles. These principles help to ensure accounting information is relevant, reliable, and comparable. Relevant information for the users that need the information to make decisions. Reliable, meaning it's trustworthy. Comparable. I can compare my company's performance to another. Comparable. When information is relevant, reliable, and comparable, it is a part of the generally accepted accounting principles. Oh, and I should also mention, the generally accepted accounting principles was created by the Financial Accounting Standards Board here in the United States, which is a governing board created by the federal government to ensure that publicly traded companies are adhering to information that is relevant, reliable, and comparable within accounting. That's just a little bit of background. The International Accounting Standards Board is similar to the generally accepted accounting principles, whereas the International Accounting Standards Board is for international organizations. Example, the International Accounting Standards Board helps to govern the accounting practice for Coca-Cola, which is an international company that has presence in countries around the world. International companies are companies that have presence in more than one country. Therefore, they follow the International Accounting Standards Board rules set forth within the International Financial Reporting Standards. Just kind of help you to understand the framework who governs accounting. The Financial Accounting Standards Board and the International Accounting Standards Board work together to create what we call a conceptual framework. And this helps to really help companies to understand revenue recognition elements and characteristics of the business. It's very general. I don't have to worry too much about this, but I just want you to understand what it is. Here are the 4 principles that I want you to really understand. The 4 generally accepted accounting principles that you need to know are measurement, full disclosure, revenue recognition, and expense recognition. I'm going to break down all 4 of them for you. I want you to remember those 4. Okay? Measurement, full disclosure, revenue recognition, and expense recognition. They're very, very specific. There's a couple of assumptions involved with principles. The going concern, which means the company has the ability to continue operating. The monetary unit, is it measured in dollars, pounds, euros, yen, etc. The time period, a day, a month, quarter, semi-annual, and annual. And the business entity, is it an S Corp, C Corp, sole proprietor, partnership, etc.? Those are the assumptions associated with the principles. And the constraint for all 4 principles is the cost-benefit analysis. And we'll talk more about all of these things here shortly. But just so you all understand, the generally accepted accounting principles governs the 4 accounting principles of measurement, full disclosure, revenue recognition, and expense recognition. And within those, we have assumptions and constraints. Here are the 4. This slide is really important. The measurement principle. This is also known as the cost principle. This tells us accounting information related to actual cost. Actual cost means how much the business actually paid for something. That's actual cost. Okay. There's a difference between the actual cost and perceived cost, or the actual cost versus the market cost. The actual cost is the amount actually paid. That's what you have to remember. The actual cost is actually what was actually paid. Total amount, paid. The next principle, one of the most important ones, is called the revenue recognition principle. In accounting, we have two types of accounting. Two types. One is called cash-based accounting, and the other one is called accrual-based accounting. Cash-based accounting is where the business records their revenue and expenses at the time cash is either received or paid. I'll say it again. Cash-based accounting is based on when the cash is either received or paid. Okay? Cash-based accounting is recorded when the actual cash is received or paid. Revenue, expenses. That's cash-based. Accrual-based accounting is when we recognize revenue at the time the revenue is earned, which is not always the same as when we receive the cash. We earn revenue when we have provided the good or the service to the customer. We earn revenue when we provided the good or the service to the customer. That's accrual-based accounting, and that's when we recognize revenue. And it's the amount that we record is based on the amount we expect to receive from the customer. Okay? We recognize the sale revenue when we provided the good or the service. And it's at the amount that we expect to receive from the customer. That's called the revenue recognition principle. Very important to understand that. It's okay. We'll talk more about this as we go forward. I just want you to really grasp that one. The other most important principle is called the expense recognition principle. This is also called the matching principle. This is when we, the company, record our expenses when they are incurred to generate revenue. Okay? For example, I received my electric bill, okay, for the month of January. Let's say we're in February. I received it for the month of January. I received it February 19th. That's from January 1 to January 31. I record that bill in the month of January. I received it in February. I record it in January. The reason for that is because I need to match that bill with the month the expense was incurred. That's the concept of the expense recognition principle, also known as the matching principle. And the fourth accounting principle is called full disclosure. This is where the company reports details behind the financial statements that impact user decisions. Notes to the accounting financial statements. Very straightforward. In other words, when something happens that might impact a decision, I type it into the notes of the financial statements. That's called full disclosure. The assumptions relating to those four accounting principles. The first is called the going concern. Can the business continue to operate? Second is called the monetary unit assumption. Is the money in US dollars, pesos, pounds, euros, yen, etc.? There's a lot of other currencies out there. The type of currency is called the monetary unit. Third is called the business entity. Is it a sole proprietor, C Corp, S Corp, or partnership, etc.? That's the business entity. How is the business organized? And the fourth assumption is called the time period. Is it a day, month, quarter, semi-annual, annual? So the typical time periods we talk about when we talk about accounting. Looking at those types of organizations again, sole proprietor, one owner, partnership, two or more, corporation, we have stockholders, limited liability, it could be one or more owner. These are the types of businesses that are organized in the United States, and it depends on the makeup of the organization. Makeup has an impact of how we record some of our accounting transactions. That's why this is important. It's not everything, but I just want you to understand it. And the constraints to accounting, there are two of them. First is called cost benefit. So when the information with benefits of disclosure are greater than its cost. Benefits of disclosure are greater than its cost. And the second constraint is called materiality. Materiality is information that has the ability to influence decisions of reasonable people. That's what materiality means. Those are two accounting constraints. I'm not going to worry too much about those specifically in this class, but I want you to understand what the constraints are. This next slide is the most important because this next slide is the foundation of almost everything you're going to do in this class. I promise you. This, my friends, is called the accounting equation. Take a close look. This is the accounting equation. I know equations. Oh, Dr. B, you said this wasn't going to be a math class. Well, it's really not a math class. It's more driven by formulas. It's kind of like math. But I promise I make things easier for you. I'm not going to have you do complex stuff. Okay? I just break it down for you. The accounting equation is written as assets. It's what the business owns. That's what an asset is. It's anything that the business owns. That's an asset. An asset is anything that the business owns. Equals liabilities. Anything that the business owes, has to pay. Owes. Liabilities. Anything that the business owes to someone else. Owes to someone else. Liabilities. Anytime you owe a payment to somebody, it's a liability. Okay? That's by the equation plus equity. Equity is what the owners own. Equity is what the owners own. I'm going to give you a couple of examples of assets. Assets would include things like cash. A business can have cash. Yeah, cash is an asset because I can use that cash to do things. Cash is an asset. Accounts receivable. Anytime your customer owes you money and they have not yet paid you, that's called an accounts receivable. You expect to receive cash eventually. It's called an accounts receivable. It's an asset to the business because the business has a claim to that future cash. Accounts receivable. That's an asset. Property, plant, and equipment. Property, that's the land. That's an asset. The building can use that land. The company can use that land to put a building on it. The building is an asset. You can use the building to help me to generate revenue. The equipment is an asset because I can use that equipment to create products. So assets are what the business owns. cash, accounts receivable, property, plant, and equipment, anything that the business owns and uses to generate revenue or sales is called an asset. Assets equals liabilities. Liabilities are what the company owes to someone else. This would be accounts payable. Accounts payable. Accounts payable represents bills that the company has received, not yet paid. Accounts payable are bills that the company has received and is not yet paid. That's called accounts payable. That's a liability because I received the bill and I got paid it. I owe it. It was a liability. Accounts payable. Wages payable. I accrued wages my employees worked and paid them yet. It's a liability. Notes payable. These are bank loans. Paid them back yet. Pretty much anything payable is a liability, yes? Plus equity, what the owners own. Equity gets a little complex. Equity represents investments made by the company's owners, which is called owner's capital, minus anything that the owners take out of the company, called owner's withdrawals, plus net income. Net income is your sales, minus your expenses. These are things that represent equity. It gets a little deeper than that, but just want you to understand the concept. Any questions at all on the accounting equation? Really, really important.
I have no questions.
Awesome. Thank you. Thank you, Ronell. Appreciate that. Great. Okay, let's keep on rolling. I want to show you a couple of transactions. Businesses have a lot of different transactions. Okay, so I'm going to show you a couple of real basic ones. And I'm going to show you how these transactions affect the accounting equation. Because remember, assets equals liabilities plus equity. The accounting equation must always be in balance. Must always be in balance. It should never ever change. In this example, an owner of the business is putting $30,000 in cash into the business to get it started. So, here's the transaction. We debit cash to increase our cash. We debit cash to increase our cash. That's our asset account. Remember, cash is an asset. We can use cash to do a lot of things in the business. And we credit paid in capital. Okay, paid in capital, which is an equity account. So I increased my cash and I increased my equity. 30,000 equals zero liabilities plus 30,000 equity. So 30,000 equals 30,000. The accounting equation is still in balance. You see? 30,000 equals 30,000. The accounting equation is still in balance. Here's an example of a second transaction. We need to purchase some supplies, some inventory. Okay? And I'm going to use $2,500 in cash to do it. So there's two accounts. One is cash and the other one is supplies. I debit my supplies to increase my supplies. And I credit my cash to decrease my cash. You see that this transaction only affects one side of the accounting equation, the assets. But you'll notice that the accounting equation is still in balance. My assets went down by 2,500 and up by 2,500. So therefore it remains in balance. Here's an example of a third transaction. We're going to purchase equipment using $26,000 in cash. I decrease my cash, $26,000, increase equipment, $26,000. Again, this transaction not only affecting the assets. Equipment is an asset. I'm going to use the equipment to help me to generate sales. Okay? So I debit equipment and I credit cash. Debit, equipment, and credit cash. I increase my equipment account and I decrease my cash account. When I debit equipment and credit cash. You'll notice the accounting equation is still in balance. Fourth transaction, I'm going to purchase some supplies on account. And you hear the words on account, it's either accounts payable or accounts receivable. If the business is purchasing on account, it's accounts payable. So I reached out to my supplier, said, hey, I need some more supplies. They said, great, we'll ship it to you, pay us within 30 days. What that does is it creates what's called an accounts payable. Accounts payable, again, is any time the business received a bill and has not yet paid it. Okay, so I received a bill for my supplies, I haven't paid it yet, it's accounts payable. So I sent the supplies along with the bill. I am going to debit my supplies to increase my supplies, and I'm going to credit my accounts payable to increase my accounts payable. In this case by $7,100. And you'll notice the effect on the accounting equation. Increased supplies, $7,100, increased liabilities, $7,100. The accounting equation is still in balance. I can go through so many more transactions showing you that the accounting equation will always be in balance, no matter what. Now let's take a look at some revenue, expenses, and withdrawals. So a few more examples of transactions. In this example, I made a sale. I sold my consulting services to a customer. The customer paid me right away. That's nice. $4,200 in cash. So I provided my services. I received cash for my services. That's called a sale. So I debit cash because I received cash from the customer. Increased cash, we debit cash. And I credit revenue. Revenue is sales. Revenue is an equity account. Remember, revenue minus expenses equals net income. Net income is equity. So revenue, I increase it, which is equity account. So $4,200. I increased my cash, $4,200. I increased my equity, $4,200. The accounting equation is still in balance. Now I'm going to pay some bills, some rent. I'm going to pay rent. I'm going to pay some salaries to my employees. I'm going to pay rent of $1,000. I'm going to pay salaries $700 to my employees. I decrease my cash. I increase my expenses. To recognize your expenses, according to the expense recognition principle, you increase your expense at the time it's incurred. So we debit expense, debit salaries expense, and credit cash. The expenses are part of equity. Okay? So when I increase my expenses, I'm decreasing my equity. Okay, because remember the equation, revenue minus expenses equals net income. That's equity. Yeah? So the accounting equation impact looks like this. I decrease my cash, $700. I decrease my equity, $700. The accounting equation is still in balance. Almost done. Doing good. Another transaction. I provided additional consulting services for a new customer. and I provided some rental to a customer. I gave my customer some equipment. They rented it from me. I also provided with some consulting. So I got a couple of different revenue accounts. The way it works here is I debit accounts receivable because I sold the stuff on account. Customer's going to pay me later. So it creates what we call an account receivable. Account receivable is an asset because you'll eventually receive the cash. So I debit accounts receivable and I credit consulting revenue and rental revenue accordingly. So I debit accounts receivable, $1,600. I credit consulting revenue, and I credit rental revenue. And this is what it looks like on the accounting equation. You see, the accounting equation is still in balance. My customer eventually pays me. So here's another transaction. The customer's finally paying me based off of their account receivable. So a couple days later, they're paying me. I debit cash to increase my cash. And I credit accounts receivable to reduce their accounts receivable. Accounts receivable and accounts payable are what we call contra flow accounts. They go up and down based off of the transactions. Yeah? The impact on the accounting equation, received cash, I decreased the accounts receivable, the accounting equation is still in balance. Another transaction, I'm paying my bills, I'm paying $900 partial payment for my supplies that I owe, so I'm going to debit accounts payable to reduce the accounts payable, and I'm going to credit cash to reduce my cash. The impact on the accounting equation, reduce cash, reduce accounts payable, accounting equation is still in balance. Another transaction, the owner is going to take some cash out of the business for personal use. Hey, cool, whatever. They're going to take $200. So I'm going to debit owner's withdrawals, which is a negative equity. Yeah, taking money out of the business is negative equity. And credit cash to reduce my cash. The accounting equation is still in balance. This shows you a summary of all those transactions we just walked through. Yeah, 11 transactions. And we noticed that the accounting equation remained in balance the entire time. We take the accounting information to create our financial statements. And I mentioned these statements earlier. The income statement shows the sales, which is revenue, and expenses during the accounting period, usually about 1 month. So revenue minus expenses equals net income. This second one I did not mention earlier. It's called the statement of owner's equity. It shows us the changes in the owner's withdrawals or investments into the business over time. The third is called the balance sheet. It shows me the assets, liabilities, and equity for the business. The accounting equation shown on the balance sheet. And the fourth financial statement is called the statement of cash flows. This is cash coming into and out of the business during a period of time. This is just a very quick glance at what those financial statements look like. Revenue minus expenses equals net income. Owner's equity flows onto the balance sheet. This shows you how the financial statements are all connected. Yeah? The statement of cash flows, it all flows. And one of the last things I want to talk about tonight is called the return on assets. In accounting, we compute a couple of ratios to help us to understand the financial health of the company in a very quick snapshot. Return on assets tells us, how well the company is using the assets to generate revenue. And to calculate this, we take the net income, which we find on our income statement, divided by average total assets. Anytime you see the word average in accounting, you take the beginning balance plus the ending balance and divide by 2. Beginning balance plus ending balance divide by 2 will give you the average. It's anything in accounting. See the word average. So average total assets, beginning balance plus ending balance divided by 2. If anything else in accounting, there's always risk involved, so it's important to understand what risk is. Return on assets, interest, return on savings account, interest involving bonds, those all involve risk. Just something to keep in the back of your mind. And as the business moves forward, we look at operating, investing, and financing activities from our statement of cash flows to help us to plan for the future of the business. Investing activities is when the company invests in property, plant, and equipment. Financing activities is when the business takes out a loan or something along those lines, financing. Right? And operating is the day-to-day operations of the business. Those 3 things are found on the statement of cash flows. That, my friends, is the end of our first chapter together. Yay, we did it! Okay. Just very quickly, I'd like to recap, and I'll cut you all loose. I apologize, we're on a few minutes over. In the classroom, for this Sunday night, what you have to do is complete the Chapter 1 quiz. Again, you have 2 attempts. Okay? The highest grade of the 2 attempts will be accepted into the grade book. It's a mix of true, false, multiple choice. It's only 5 questions. Okay? And I promise you, it'll be very, very easy. All you need to do is use your PowerPoint presentation, notes from today's lecture, and do a little bit of reading from that first chapter. Promise you, you'll do fine. 2 attempts. The highest of the 2 attempts will be accepted in the grade book. And that's due on Sunday, the 15th. Any comments, questions, concerns?
Hi, Professor. So we can use our notes during the exam?
Absolutely.
Oh, okay.
Absolutely.
And what is the proper way? 'Cause I was paying attention, but I think because this is all kind of new to me. So what is your recommendation like during class? Is it just more so to just focus on what you're saying instead of like trying to like write the notes, or what's the best way?
Excellent. Yeah, good question. So my recommendation is to, throughout the lecture, just kind of, jot down some notes. I recommend that you, try to glance at the chapter before class, because that usually helps you to kind of follow what we're going through. Look at the PowerPoint before class, and then jot down some notes throughout the lecture. I think that's probably going to be the best approach.
Okay.
Great question. Thank you. Any other comments, questions, concerns? We'll be talking throughout the week. It's okay. Go ahead. Whoever's next.
Is the quiz on lockdown browser, or is
No,
it?
it's open. It's open. No lockdown browsers.
Oh, good. Okay, thanks.
Question. You got 2 attempts. Highest of the 2 attempts is taken then. Yep. Anything else?
Yeah, I just want to eventually have a better understanding of the transaction sheet you went through with the different transactions, and how it. You like after every transaction you said that it was unbalanced, but on both sides it was equal. I want to understand how is it unbalanced if both sides are equal as far as like the balance number. But you don't have to get into that now. I would like to have a better understanding of that.
Sure.
Just the arrows, the red and the green arrows.
Yeah. So that represents like the whether the asset or the equity or the expense or whatever is going up or down. Yeah. So when it's going up, that means it's green. Down is red. And what these represent, when it shows it in relationship to the accounting equation, it shows that the totals are always in balance. So assets equals liabilities plus equity. That accounting equation is what's always in balance. That's always in balance, balanced, I should say. I hope that helps a little bit.
I mean, I think I may understand that, but I still need some better understanding because it says 3,900 and I mean 39,600 equals 39,600. So how can it be unbalanced if they're both equal? That's where I'm kind of stuck.
Yeah, that's what I'm saying. In balance, in balance, it balances. They balance, right? So in other words, 39,600 equals 39,600. The accounting equation is in balance. Assets, the total assets, 39,600 equals the total liabilities plus equity, 39,600.
That makes sense. In a sense, it makes sense.
Cool. So, yeah, and again, anytime if you ever have questions, just feel free to contact me. I'll be happy to help.
I will. Thank you.
Great. Any other comments, questions, or concerns? Okay, wonderful. If you ever need, you can email me, call me, set up office hours, whatever you need. I'm here for you 100% of the time. All of my contact information is here on the website. If you want to set up office hours, there's a link right here for office hours, and I will be here for you. Thank you all so much for your time today. I appreciate all of you. Enjoy the rest of your night, and if you ever need me, just feel free to contact me. Thank you so much. Take care, y'all.
Thank you. You have a wonderful night.
You too. Bye-bye.
Thank you.